So this is Jennifer with Vorsa Investments, and I have the wonderful and knowledgeable Neal Bawa on. And I am so excited to get to speak with him and hear his take on what's going on in the investment world and, how this pandemic, relates to us and how do we pivot and how do we talk to our investors? Like, how do we encourage them to lend in scary times like this?
I think, lots of good questions. I'm not sure if I have good answers, but what I'm finding is that what is working for us, and it definitely is working because we did a new syndication raise last night, and the interest level was phenomenally high. And so the question I ask myself today is, in the middle of this pandemic, when people are losing money in the stock market and they're concerned about the fact that real estate is, could be illiquid because renters are not paying rent, why did I have, 350 investors show up for a webinar that I was doing for a new construction project? New construction is usually considered more risky than value add. And I think the biggest answer was that because I have been communicating with my audience more aggressively in the last 30 days than I have before that. So in the end, I think the answer to your question is, you want investors to lend to you. You want investors to invest in your project. The biggest thing that you should be doing is talking with them, communicating with them. So we've sent emails, we've sent videos, we've done webinars that are structured with content. We've done town halls. In fact, we've now done 3 town halls and 3 webinars, and we've had 2,800 people attend them live, and about 4,000 people watch the recordings. I'm sure there's overlap between them, so it may not be 2,800 unique people, but certainly we've had our Zoom licenses in every single case maxed out. We have a 500 user Zoom license, and we were just at 500 the last 3 times we did the town hall. So number one, know that there's interest. Investors want to know more about what's going on. Put yourself in that position of being the person that gives them the information about what's happening with the PPP, what's happening with the PPP loan, what's happening with the IDL, EIDL, what's happening with lenders, what's happening with real estate investors. And by doing that, you put yourself in that position of credibility where they're more likely to look at you, because in the end, they've still got money. In some cases, they have more money because they've just sold their stock. They panicked and they sold their stock, and now that money is sitting in the bank, and they want to do something with it. So I do not believe, having seen what I saw last night, that the market is illiquid from the perspective of lending or from the perspective of investing. Quite the opposite. People are now looking to invest with people that they trust. So they're less likely to invest in CrowdStreet or crowdfunding because they don't know those people. But they know Jennifer. They know that Jennifer's a straight up person and is going to take care of their funds. So they're actually much more likely to invest with you at this point in time, in my opinion. So that's what I'm seeing. Communication with investors is absolutely critical today.
Yeah, super exciting stuff. And I'm also excited about the new retirement plan that just came in. So people now have 100% access with no penalty to their retirement plans. Like, to me,
that's huge.
Yeah, this is the time when millionaires are going to be made.
You've got the ability to pull out that money. You've got the ability to extend your 1031, which, a lot of 1031s were worried about the fact that they may not get extended. Now you have the ability to extend those, I think, up till July 15th, if I'm not mistaken. So there's good stuff, there's bad stuff, but there's also good stuff happening. And one of the things that we've seen, and I'm assuming that, if you're looking to work with investors or lenders, they're primarily either doing single family homes or multifamily homes in some way, right? So if they're doing those markets, the message for them is they have now seen in a way that is crystal clear the difference between need-based assets like single family and multifamily and want-based assets like hotels and retail. So we're seeing a complete debacle happening in the hotel and strip mall market, the mall market, because 70-80% of tenants are not paying. Marriott, I mean, the biggest hotel chain in the world, has laid off all of its staff. That's a debacle, right? Find me one apartment operator in the United States that's laid off one employee. And you're going to have a lot of trouble with that. Why?
Mm-hmm.
Because for April so far, it looks like about 80% of our rents are coming in. We're not happy with 80%, but it's not a world-shaking event for us. It simply means that all distributions until the end of this year are gone, right? So if I had investors, instead of them making 8% this year, they're probably going to make 0% this year, even though it's going to recover in the second half of the year, because I still have to catch up on some of the losses that I'm taking in April and May and possibly even in June. But what we've seen, and this should give a lot of confidence to anybody investing or lending into the real estate space, is that when you're investing into homes, people treat them a different way. Even though a lot of people were laid off, still 80+% of the rents in the apartment and landlord industry have come in. I'm not trying to say it's a good situation. It's painful. I have a lot of tenants myself for my single family properties, and some of those haven't paid either. So it's a painful situation to be in. But painful is different from world changing. If you were in the retail space, world has changed for you. If you were in the hotel space, the world has changed for you. If you work for an airline, the world has changed for you, because there's 100% shutdown. Whereas with the vast majority of real estate assets, we're still getting enough rents for us to pay our mortgage. And if we don't pay our mortgage, we have mortgage forbearance from Fannie and Freddie, which may not be applicable. Airlines that have paid, bought jets from Boeing don't get mortgage forbearance. Malls don't get mortgage forbearance. They have to negotiate it. But in our case, for single family, multifamily, a law was created that said, nope, you guys have to give these people 90 days of forbearance. So doesn't that tell you that real estate is really a privileged asset class, because no one needs the stock market to have a roof over your head, but everyone needs a rental home or a purchased home to have a roof over your head. So in many ways, this is going to lead to, when people realize this a year or 2 years from now and they look back at this debacle, they're going to say, what came out of this market strongest was the single family, multifamily market. That's where we should be investing in. You're going to see money flowing from other asset classes over the next 2 to 5 years into single family and multifamily. And so I think it makes sense to lend on good projects. I think it also makes sense to be careful about leverage, and you want to leverage them a little bit less than you were doing it a year ago. You want to look at the quality of the project, the quality of the syndicator. But I don't think that real estate money is illiquid at this point. I just feel like your risk level is a bit higher and you need to be careful about it.
Sure. I kind of am looking in the future, and I think that a lot of people, and I may be wrong, but I'm guessing that a lot of people don't understand the difference between forbearance and forgiveness. And I foresee, and when this is over and the mortgage companies are paying these homeowners with, multiple thousands of dollars that they're not going to be able to come up with, that we're going to see a huge rise in foreclosures. And these people have to go somewhere. So is this not the best time to be investing in working class apartments, where these people, they're going to migrate somewhere?
Well, possible. I believe that depends on the duration. So what I'm going to give you is, instead of a yes or no answer, I'm going to give you scenarios. And you have to decide, each person watching this podcast has to decide, what do you believe? Okay? So today is April 14th in the United States. It's clear that not only in the US, but everywhere in the world where there have been shutdowns or shelters in place, they are working. They are unquestionably working. We see a very clear decline in cases. So the hammer phase, where you hammer down the coronavirus, is clearly successful if one has the will to do a shutdown. So the big question is not the hammer phase. The big question is the dance. So at sometime in mid-May, the United States will transition from the hammer phase, which is shutdown, to the dance phase, where we reopen portions of our economy. I hope we don't open movie theaters and baseball stadiums, because that's just insane. But I do think that we are going to need to open restaurants and public transportation and offices. That has to be done. Otherwise, we won't have an economy left. So bottom line is, that what is your core belief on that? If you believe that 80% of the US economy is going to reopen sometime in May or the beginning of June, then in that case, I don't see a meltdown coming in the single family marketplace, because everybody got paid for March, so it's April, May, and June. So if 3 months of mortgage payments are missed, if you're a landlord and your mortgage payment was $1,000 a month and you didn't get paid by tenants for all 3 of those months, that's a worst case scenario, right?
Mm-hmm.
A lot of the tenants are paying, they're paying partial payments or whatever. I don't think that homes are going to go on the auction block or get repossessed for $3,000. Why? Because the value of that home hasn't declined. And so a landlord is going to just say, I don't know where I'm going to get this money from. I'm going to borrow it from mom. I'm going to take it from dad. I'm going to go get home equity, but I'm going to pay these $3,000 back.
Mm-hmm.
So to me, I think if this is a case where 80 to 90% of America goes back to work on July 1st, you're not going to see large scale meltdowns in the single family marketplace. Are you going to see some price declines? Almost guaranteed. Are you going to see some opportunity in certain areas that are harder hit, such as areas with oil crashes, or areas such as Orlando or Las Vegas, where the hit has been much bigger, right? So 28% of Las Vegas is either retail or hotel, so the hit there is much bigger. So some of those areas, you're going to see, a significant amount of single family come to market. And in every other area, you're probably going to see a price decline there as there's more, buyers, there's more sellers than buyers. So I think we see deals. But I would tell you this, that my belief is that unless we fail at the dance phase, which means we end up, doing 6 weeks open, 2 weeks closed, 6 weeks open, 2 weeks closed. Basically, we go into this rolling shutdown mode. If that happens, yes, you could see a significant amount of distressed assets, come to market. I think right now that the likely scenario is that we will reopen, but we'll reopen fairly carefully, and we'll have hotspots that will be shut down. But hotspots is okay. The U.S. economy, every single week of the year, there's some city in the U.S. that's undergoing a hurricane or a tornado, or there's flooding going on somewhere. It doesn't shut down our economy, right? So I think those sorts of things are common, and if you treat it as such, that there's going to be hotspots, and those hotspots will need to shut down again, fine. That's not the reason for large-scale defaults to happen. So I think that you're going to see some opportunity in the marketplace in Q3 on the single-family side. You're actually going to see more opportunity in Q3 on the multifamily side, because the multifamily market, from a lending perspective, has become almost illiquid, right? If I'm a good lender, if I'm a big buyer, I'm a doctor and I have $2 million in the bank and I want to go buy an $8 million building, I can do that right now. But if I want to put a syndication together, right, it's much harder to raise money. And then the banks are basically saying, well, I need 12 months of impounds. I need taxes and mortgage to be impounded. So now instead of raising $2 million for my $8 million building, I have to raise $2.5 million or $3 million. So there's challenges there. And then on top of that, the banks are saying, well, before I was giving you leverage all the way to 83% for bridge loans. Now I'm going to give you leverage all the way to 70. Well, now you have to raise a lot more equity and your project is getting worse. And then the lender is saying, well, I was giving you a DSCR of 1.2. Now that has to be 1.4, right? So the market that I believe in the short term is hit is actually the syndication part of the multifamily market, where we were gathering money from investors and we were basically buying assets. Now those assets cost a lot more to buy in a weird sort of way, because we have to gather a lot more equity. So until the price of those assets goes down, which will happen over 2, 3, 4, 5 months, the price of multifamily will decline. Until that happens, it's going to be hard for the syndication industry to justify itself. So I think that the syndication part of the multifamily industry is going to get hit harder than the single family industry, because as I said, if you're going to lose 3 months of rents, you're not going to give up your rental property for that. I don't think anybody will do that. So I don't see a huge number of homes coming to market.
Good. Well, that's good. And it's encouraging. And, I mean, it's kind of, it's give and take. It's a little bit of bad news, but there's some good news in there. And so, still good.
I think so.
To look
I think it's a
forward
mix.
to, and
Yeah.
really nothing to be horribly afraid of,
I don't think so. I mean, I would be horribly afraid if I was running a hotel chain. I would be horribly afraid if I was running a cruise line. I think that the want-based asset classes are taking longer to come back, and in our group, we are particularly looking at the China economy to figure out what's happening. So what we are seeing is that real estate's taken a hit after China came back, but it hasn't taken a huge hit. And the portions of real estate that have taken hits were the ones that were connected to retail and hotel and things like that. But single family and multifamily homes have taken a smaller hit in China as it's come back. And the China economy is up to 80% of its output before they were hit by the virus. So if you look at their Q4 output and you look at their output now, they're there 80% of the way. Well, if we end up being 80% of the way here, then I don't have much to fear for the residential market, right? I still think 80% will hit the rest of the economy very, very hard, right? 20% of the economy lost is huge. But the residential side, everybody needs a place to live. So if 80% of those people get reemployed, I think as a landlord, you'll do fairly well. You're probably not going to have as good of a year as you did last year. Actually, for sure, you're not going to have as good of a year as you did last year.
Right.
But it's not a gloom and doom. The way I look at it is I'm trying to prep my investors for, look, we told you we double your money in 5 years, or we try to double your money in 5 years. We still think that we're on track. But now we're on track to do that doubling over 6 years, not 5, right? Because this is like a lost year for us in terms of cash flow and in terms of returns. But if that's the only thing that's going to happen, big deal, right? If doubling in 5 years is 20% annualized, doubling in 6 years is about 16.5% annualized. Not a bad situation to be in the middle of a crisis that's the most unique crisis in the modern era.
And still more money than you make in the stock market. So
well, right now everything in the world makes more money than the stock market. So I think that's an easy comparison for real estate. To be honest, real estate has had one of the charts that your listeners and viewers should look at is look at how many down years the stock market has had in the last 50 years, and then look at how many down years real estate has had. You'll notice that for real estate, it's one single year. And it was 2009 or 2010, one of those two years where real estate was really down. But other than that, real estate hasn't had a down year as an asset class in a very, very long time. And so it fundamentally tends to be more stable because you don't need stocks to have a roof over your head either.
Awesome point. Yeah, exciting stuff. So I'm excited. Just the whole, retirement plans. I think that just opens up so many doors to
and I think
really
some
build
of the
true wealth.
Market money, every time this happens, when that money moves out of the stock market, some of it doesn't go back into the stock market. It ends up living in real estate and then staying there for a long time. There are other graphs that are very interesting that show that if you look at large-scale portfolios in the United States, real estate used to be 5% of those portfolios in the year 2000, 5%, right? And then the remaining 95% was stocks and bonds and everything else, businesses. Today, real estate is pushing 25%. So in 20 years, we've gone from being 5% of the US stock portfolios to being 25% of the US stock portfolios. What's interesting is the same article goes on to look at projecting that into the future, and it says in the next 10 years, we will go from 25 to 40%, right? So in general, people, real estate used to be thought of as an alternative investment. That's no longer the case. People don't think of it as an alternative investment. And so if you're looking at retirement money, you really have to make sure that real estate is a component of that. So the way I look at real estate, and you may not be ready to invest today in the middle of coronavirus, but I can tell you in the long run, you're going to become a landlord, whether you like it or not, because this is now becoming one of the key asset classes in the world. So you're either going to become a syndication investor or you're going to end up becoming a landlord, whether you like it or not, because that's where the cash flow is left in today in a world that has very little cash flow.
Awesome. All right. So what golden nugget from all of this can the great Neal Bawa give us to, part with and just kind of hold on to during this time?
Well, the biggest one that I want to give you is that the fundamentals of buying real estate have not changed, right? So in the next 6 months, watch out. You may not want to invest in Orlando or Vegas or the oil patch. That will go away, right? So that will go away. The fundamentals are that you want to invest, whether you're lending or you're investing, single family, multifamily, wherever it is, you want to invest in places that have these 5 things. And I'm going to show you a resource that tells you how to get information. So number 1, population growth. Number 2, income growth. Number 3, home price growth. Number 4, job growth. And this one's the most important of them all, as we've seen in the last month. And then number 5, crime reduction. As long as when you're looking to lend, when you're looking to invest, you're looking at these 5 metrics, you're going to do well. And now people are like, okay, so that makes sense, but I need more information about these metrics. How do I get them? How do I use them? How do I compare them? So what I did was I wrote a 2.5-hour video course, which is a course of me. So you're going to be watching me and then watching my screen at the same time. And the course is stored on multifamilyu.com. That's multifamily followed by the letter u.com. Go there, click on learn, click on location magic, and you'll take a 2.5-hour course that's going to show you not just how to use these 5 metrics to figure out the best cities in America to invest in, but an additional 5 metrics that'll show you how to invest the best neighborhoods in America to invest in. No one will call you and try to sell you anything. There's no upsell. It's a completely free product, and it doesn't have any kind of upsell. There's no CDs to buy. There's no subscriptions to buy. So go to multifamilyu.com, spend 2.5 hours in a data-driven course. And I think it's more than a nugget. In my mind, it's a treasure chest because it'll turn you immediately into an elite investor. Less than 1% of investors, real estate investors in the US, know this information, and even most of those don't have it in this structured format. And you'll have an Excel spreadsheet where you're going to plug in 2 numbers for each of those metrics, and it's going to give you a thumbs up and a thumbs down. So you'll know whether to invest or lend to that particular project. That's all you need to do. So that's my favorite nugget because it's a big one. I
that's
say
awesome.
50-kilo nugget, right?
Yeah, that's super exciting. And so you also have a podcast. So if anybody wants to follow you on your podcast, what is that called and where do they follow?
So, most people think I have a podcast, but I actually don't. And the reason for that is because I am on a podcast twice a week. So people keep telling other people about, hey, Neal Bawa's podcast here or there. But there's over 100 podcasts that I've done on various topics in single family and multifamily and even other aspects of real estate. And those podcasts can be found in the easiest way possible. All you have to do is Google my name, Neal, not Neil, but Neal, Bawa, B-A-W-A, and hit enter on Google. Just my name, Neal Bawa. And now you're going to see these massive numbers of podcasts that I'm talking about one topic or the others. There's some duplication, but I talk about everything from outsourcing with virtual assistants. I have an army of 20 virtual assistants. I talk about those. I talk about asset management, managing large properties. I talk about underwriting. I talk about city selection, neighborhood selection. Of course, the last 10 in some way or the other have been about the coronavirus pandemic and its impact. So you want to check those out, just Google my name.
Awesome. Okay. Well, that was awesome information. I appreciate your time, and we'll get this out. And I did see you on the Apartment Guys podcast, my buddy Tate, and it was exciting. I was excited that you were on there, and we'll be sure to get that Excel spreadsheet. I'm super excited about it, and it was great speaking with you. Thank you so much for your time.
Thank you, Jennifer. Thanks for having me on the show.